Hey traders, Todd Gordon here with TradingAnalysis.com. This is for CNBC's Trading Nation. Traders, today we're going to look at a different kind of strategy in the options market. Markets don't always go up or down. Sometimes they go sideways. And when you use the options market, you can actually use that sideways consolidation to your advantage. And we're going to set up an option strategy right now called a butterfly. The reason we're doing this is we look at the S&P. This is the SPY, the tracking ETF. You can see the market has, since last July, made a big push up. We settled down into a correction. We've made another pretty spectacular move into 2017. And if you use Dow theory, which is classic technical analysis, or a little bit more involved in that, something called the Elliott wave theory, you would see that we are about due for another correction. And that correction should be similar in price in time to this last correction. So we could see something very similar, and it's the 1 year anniversary since the election rally. So this sell-off into the election rally in November lasted approximately 3 months. So we might be headed into a period of consolidation, and you can use the options market to your advantage to benefit from that. So what we're going to look to do is we are going to do this on the put side. Essentially what we're going to do is sell two puts right around where we believe to be the middle of the range, where the range will unfold. Then what you're going to do to protect yourself, you're going to buy a put above and buy a put below. And what you're looking for is essentially just sideways movement. And as long as we stay right around the current level of about 250 in the SPY, we should be able to make money if the market goes sideways. So again, we're going to sell right around the 250. We're going to sell two of these puts. We're going to go out into the November monthlies, and I'm going to go ahead and buy a 257 and buy a 243 right around here. So provided the market stays in here, we should make money on this trade. It doesn't matter if we go to the top side or to the downside. Ideally, we want to go right down the middle. So here's what the trade looks like. In the November monthlies that expire in 60 days from this recording, we're going to go ahead and sell two of the 250 puts. We're going to go ahead and buy one of the 257 puts above and one of the 243 puts below. So you're long two options, short two options. The idea here is you want the market to hang around that 250 strike, bringing the value of those options down, which is good because we're short those options. If those values decrease, we make the money. Okay, and then the 243 and 257, that's going to act kind of as our barriers to unlimited risk. So we want to stay within that range. So moving down to the P&L graph, here's what we see. Now the whole trade is going to be a debit. Okay, we're going to pay $251 per option butterfly. Okay, 251. Now, if the market gets outside of the range, you're going to look at the purple line where it gets flat. And as you look at the P&L right here, okay, you're going to see that the max loss is about $250. If we get below just about $243 in the S&P, you're going to lose $250 of capital. If we get above in the S&P, we have a sharp breakout. If we get above 257, you're also going to lose $250 of capital. So that's your risk. Okay, now what's your reward? As you travel up the purple line here and you're looking up the left scale here, that's your profit. And as this purple line gets more and more elevation, watch what happens to this figure right here in purple. The profit goes from $130, $190, $200, and then at the very peak, if in November we're at $250, exactly where we are right now, that's a profit of $447. So bottom line, you're risking $250 to make $447 if the market goes nowhere. Now, if you look at, okay, what's going to happen prior to that November expiration? The platform has built in some nice features here which shows you your P&L at different periods heading into expiration. This orange line, as we show right here, is your profit and loss today. So this orange line at the peak, if we're like right now, it's going to be nowhere. But if you look one level up, that's the teal line. That's going to be the profit and loss on October 19th, 1 month from now. That's going to be a profit if we're right there, just at about $74. Okay, and again, watch that this teal figure right here as we slope off. Our break even 1 month from now is going to be right at about $240.77. That's going to be our downside break even. On the top side, if we rally too much, we're going to hit the break even at about $254.43, and that's going to be where we begin to move into negative territory. So in between those two figures, that's all profit. And what I recommend you do is, as you spend $250, once you start to get $250 in profit, begin to take that trade off and protect. Don't go for the home run and try to get the whole 250 pin at expiration. Don't go for the whole expiration. Kind of manage that thing. When the capital you put out there equals your profit, begin to take that off. So I don't know when the debit we just put out will equal your reward, but it will be at some point in the future, provided you stay in between the lower and upper boundaries. And that's, guys, how you trade a sideways market. For CNBC's Trading Nation, I'm Todd Gordon. Good luck on that rather complex options trade. Be sure to follow us at Trading Nation on Twitter for updates to this position as well as all the other trades our traders are watching. And we'll see you guys in the next video update.